Most people think a $30,000 watch is an investment. It's actually a really expensive way to lose money. Here's the math nobody talks about. You walk into a boutique, see that Rolex Submariner gleaming under the lights, and the salesperson tells you it holds its value, maybe even appreciates. Your friend just flipped a Patek Philippe for double what he paid. The internet is full of stories about vintage watches selling for millions at auction. So why wouldn't you put money into something you can wear on your wrist instead of watching numbers bounce around on a screen? Because the numbers tell a completely different story. Let's establish what makes something an actual good investment, not just something that doesn't lose all its value. If you put $100 into something and get back 90, that's terrible. 101, still bad. 150, getting warmer. But where's the actual line? The stock market gives us that line. Over the past century, the S&P 500 has averaged about 10% annual returns. Some years up, some years down. But the pattern holds. That's the benchmark. Anything you invest in needs to match or beat that number, or you're better off just buying an index fund and forgetting about it. No expertise required. No market timing, just steady, boring growth. Now, watches. How do you even evaluate a watch as an investment? You can't compare them to stocks, which represent ownership in companies that generate actual cash flow. Dividends hit your account. Businesses grow and create value. Real estate works similarly because you collect rent, an actual income stream flowing back to you month after month. Watches don't generate cash. They sit there, looking nice, sure, telling time, obviously, but they're not producing anything. They're not commodities either, which derive value from utility as raw materials. You can't burn a Rolex for energy or build a house with an Omega. The value of a luxury watch comes entirely from cultural dynamics, fashion trends, brand prestige. How many wealthy people exist at any given moment who want to signal status through what they wear on their wrist? It's abstract, subjective, and constantly shifting based on factors that have nothing to do with the actual object. There's organic demand, which is real. People who genuinely appreciate the craftsmanship, the engineering, the history. Enthusiasts who study movements and complications. Collectors who love the artistry. Even people who just want a recognizable status symbol because they like how it makes them feel. That demand is legitimate because it's tied to the watch itself. Then there's artificial demand. This is where things get messy. People buying watches specifically because they're told it's a good investment. Flippers waiting to score a retail Rolex so they can immediately sell it for 50 or 100% profit. Speculators accumulating inventory of specific models to create artificial scarcity, controlling supply until they can charge whatever inflated price the market will temporarily bear. You've probably heard of the greater fool theory. An asset might be overpriced, but it's still worth buying if you believe someone else will pay even more later. The watch skyrocketed in value over 6 months. It's probably overvalued, but you think you can find another buyer willing to go higher. Keep passing the hot potato. Eventually, you run out of fools. That's what happened when the watch market collapsed in the second quarter of 2022. Prices had climbed astronomically. A 24% increase in overall market prices in just 3 months, completely unsustainable. When the music stopped, everyone holding watches they'd bought purely to flip suddenly had no buyers. Forced liquidation, panic selling. The bubble popped. But forget short-term volatility for a moment. Let's look at what actually happens when you hold a watch for decades, and which is how real investments should work. Take a 1978 Rolex GMT Master, reference 1675. Today it lists for around $31,000. Back in 1978, retail price was $795. You buy it then, never wear it, keep it in perfect condition, pay nothing for servicing or insurance or storage. Pure fantasy scenario, but let's run with it. 45 years later, you sell for $31,000. That's a 3,900% return. Sounds incredible, right? You turned less than $1,000 into over $30,000. Except if you'd put that same $795 into the S&P 500 in 1978, you'd have over $128,000 today. The stock market returned roughly 16,185% over the same period. More than 4 times what the watch returned, and that's assuming zero costs for maintaining the watch, which is completely unrealistic. Storage, insurance, servicing, these costs compound over decades and eat directly into your returns. The stock market just sits there growing while you sleep. So what does this actually mean for you? It means categorically dismissing watches as investments would be unfair. Some do appreciate, but the overwhelming majority don't. Most watches depreciate the moment you walk out of the boutique. Even the prestigious names, Rolex, Patek Philippe, Audemars Piguet. These aren't guaranteed wins. They're just less likely to completely tank. The challenge is identifying which specific models will appreciate before everyone else figures it out. Think about vintage pieces from the 60s and 70s. The Paul Newman Daytona was unpopular when it launched. Collectors ignored it. Dealers couldn't move inventory. Now it's one of the most valuable watches ever made. But how could you have known that in 1970? You couldn't, unless you had a crystal ball or an uncanny ability to predict cultural shifts and decades in advance. Selecting undervalued watches today requires more than research. You need deep intuition about fashion cycles, luxury market psychology, and generational wealth transfer. What will wealthy 30-year-olds want on their wrists in 2040? Which brands will maintain prestige? What design language will age well versus looking dated? These questions don't have clear answers. Getting it right once might be luck. Developing a repeatable strategy that consistently outperforms the market? Nearly impossible. Then factor in the hidden costs nobody talks about. Transaction fees when buying and selling. Servicing every 5 to 7 years, which can run hundreds or thousands depending on complexity. Insurance premiums if you're holding valuable pieces. Secure storage. These expenses accumulate silently over decades, eroding whatever gains you might see. The index fund has none of these problems. It just compounds. Here's where most people go wrong. They confuse enjoyment with investment. You love watches. The engineering fascinates you. The history resonates. The way a Cartier Santos sits on your wrist feels right. So you buy it, then justify the purchase by calling it an investment. But wanting something and that thing being a sound financial decision are completely separate. This mental trick lets you spend guilt-free, but it's self-deception. The watches you personally love are statistically unlikely to be the ones that appreciate most. Your taste and market performance rarely align. If you're honest about wanting the watch for yourself, that's fine. Buy it, wear it, enjoy it. But don't pretend you're making a savvy financial move. You're spending money on something that brings you joy, which is a perfectly valid reason to buy anything. The problem starts when you convince yourself it's both. Can some watches match or beat the market over multiple decades? Probably. Will you be able to identify them in advance with any consistency? Probably not. Will focusing purely on investment potential mean ignoring the pieces you actually want to wear? Definitely. That's the trade-off. You can chase returns or chase passion, but trying to do both usually means succeeding at neither. Data and transparency help, but they don't eliminate the fundamental uncertainty. You can research historical pricing trends, analyze market conditions, study brand trajectories, all useful information. But past performance doesn't predict future results, especially in a market driven by subjective taste and cultural momentum. The Richard Mille hype could evaporate. Tudor could become the next Rolex. Omega might surge, or everything could stay exactly where it is. Nobody knows. What you should take from all this is simple. Be honest with yourself about why you're buying. If it's for enjoyment, own that. If it's genuinely for investment, treat it like any other financial decision. Compare expected returns against alternatives. Factor in all costs. Accept the risk of being completely wrong. Don't use investment as an excuse to justify emotional purchases. The distinction matters because it changes how you evaluate success. If you buy a watch you love and wear it for 20 years, that's a win regardless of resale value. You got exactly what you wanted. But if you buy expecting it to fund your retirement and it depreciates 40%, that's a failed investment. Same watch, different framing, completely different outcome. Most collectors would be happier if they stopped pretending every purchase was strategic and just admitted they like nice things. There's no shame in spending money on what brings you happiness. That's actually what money is for. But calling it investing when it isn't creates false expectations and eventual disappointment. So the next time you're staring at an IWC in a display case, ask yourself what you're really after. The watch itself or the fantasy that it'll pay for itself someday. One of those is attainable. The other is a comfortable lie that keeps people trapped between enjoyment and regret. Choose deliberately, and whatever you decide, at least you'll know why you did it. The reality is, watches and stocks serve fundamentally different purposes, and pretending otherwise just clouds your judgment. Stocks are financial instruments designed to grow wealth through compounding returns. Watches are luxury goods that might occasionally appreciate but weren't built for that purpose. You wouldn't buy a painting expecting it to outperform your retirement account, so why hold a Patek Philippe to that standard? Enjoy the craftsmanship. Wear what makes you feel good, but keep your actual investment strategy separate. Your wrist and your portfolio don't need to justify each other.